Hello students, you are the future chartered accountants of India. Welcome to our YouTube channel Abhi CA Classes. I'm Abhijith Acharya welcoming you for today's next chapter, that is income from house property. We have discussed till income from salary as in the last class. Today we are going to complete the next chapter, that is income from house property. This is the second heads of income. First one salary, house property. Third one is PGBP, business income. Fourth one is capital gain. Last one is income from other sources. Today we are completing. We are going to complete the second heads of income, that is income from house property. Okay, and if you have not subscribed, please subscribe to my YouTube channel. And this is the gentle reminder. Okay, before starting this chapter, I will clarify you. This chapter is categorized as it is categorized as a B category. Okay, this also forms an important chapter for your examination. Okay, without wasting further time, let's get started today's class. For section 22 says that this is a charging section. Rental income is taxable under the income from house property if only the following two conditions are satisfied. If one thing is to be taxed under income from house property, the following two conditions to be satisfied. Number one, there should be a house property, and the land also can be considered as house property if the land is situated apparent to that house property. Okay, there should be a house property. Second, the assessee should be the owner of that house property. If he is a tenant, then there is no income at all. If he, then he should be the owner of that house property. That two conditions should be satisfied in order to charge the income under income from house property. That's it. Second, there are two types of house properties. Number one, self-occupied house property. The other one is lettered house property. Self-occupied house property in the sense you are residing in that house property. The SSE and his families is residing in that house property. Lettered house property means the SSE has given his house property for rental purpose, for lease purpose, and he is receiving some income out of that. That's it. First, we will discuss the self-occupied house property. If the self-occupied house property is utilized for the residential purpose, for his own residential purpose, then we have to see if he is having more than two self-occupied house property, then up to two house property exempt is nil, because there is not at all an income. There is no income will be generating in that, right? Because he only residing in that. But there is one restriction that up to two house property, that those house properties can be treated as self-occupied house property, and any income generated out of that will be treated as nil, because there is not at all there is no income at all generating from that house property, right? But if that assessee is having more than two self-occupied house property, the remaining the up to two house property, that is treated as self-occupied house property and nil. Remaining self-occupied house property is there, no, that will be treated as deemed let out house property. Even though it is not at all let out, but it is deemed as it is being let out. That's the simple terms. But there is no rental income also. But the treatment of this house property will be same as whatever the treatment will be applicable for let out house property is applicable to this house property also. Up to self-occupied house property, it is treated as exempt. More than two self-occupied house property is owned by the owner or the SSE, then the remaining property is treated as the deemed lettered house property. Okay, if the self-occupied house property is used for business or profession, for example, I am a doctor and I am using my house property as a clinic, then whatever may be the income generating in that clinic is not treated under income from house property. Should be treated under as of now, or I should be ignored for that income from house property, because it is treated as that business income, right? That's why. And another type is let out house property. It is always taxable. Okay, it is always 100% taxable. Super. Then Finance Act, there is one amendment or circulars brought into effect in the Finance Act 2019. It says that where, I will just read out once, where house property is held as stock in trade. Stock in trade in the sense that SSE is a trader. Okay, I think you have understood the concept of stock, closing stock. The closing stock can be defined as for those who is having trading in that income. For example, if I am having a trading income, I am having the trading business of a sale and purchase of laptop, then the closing stock will be treated as the laptop will be treated and closing stock will be there, right? Opening stock, closing stock will be there. If I am a purchaser, not having any business, then that is called as my asset. That's it. It is not a closing stock. Where house property is also held as stock in trade. That means he is a broker in simple words. And property is not let out during the whole or any part of the previous year, that is in the 23-24, the annual value of such property shall be taken to be nil. It cannot be deemed as let out house property. That's why I'm focusing the point deemed let out house property. For how many years? For the period of 2 years from the end of financial year in which certificate of completion of construction of that house property is obtained from local authority or municipal authority. Okay. For example, that up to 2 years, it cannot be deemed as let out house property. That's it. The hospital is not let out during the whole or part of the year. It is not at all been sold out, but it is not at all let out. In that case, then it cannot be treated as deemed let out house property, and hence we will take that value as nil up to only for 2 years from the date of end of the financial year, which is COC, that is certificate of completion certificate is being received. That is, COC is received on 1st April 2022. Up to 2 years, that is up to 31st March 2024, even though the asset is not, house property is not at all sold, not at all let out, then the value should be treated as nil. After 1st April 2024, it can be treated as deemed let out house property. The treatment will be same as deemed let out house property. Understanding, right? Super. Then computation of, there is one statement that we have discussed the statement of salary. In the same way, in the similar manner, there is a statement of house property. First, we have to take the municipal value of that house property. Remember, for self-occupied house property, it is always nil because there is no use of computation of self-occupied the rent of, because there is no value at all for self-occupied house property, right? Because you are not paying any tax for the self-occupied. There is no income. You are residing in that house property. And why there is the importance to be given for computation of that rent, right? If that municipal value to be taken for let out house property, first we will discuss the self-occupied house property. It is always nil. We will not touch it all. Okay. For let out house property, municipal value we have to check. Then fair rent. The definition will be discussed in the next upcoming points. Fair rent, whichever is higher we have to see, then that we have to consider. Okay, municipal value or fair rent value, whichever is higher. That higher amount should be compared with the standard rent, then out of which higher amount and standard rent, whichever is lower, will be treated as expected rent. Okay, then expected rent and actual rent received, because in self-occupied there is no concept of actual rent received, can be taken for the let out house property. Expected rent and actual rent, whichever is higher, can be treated as gross annual value. It is a value of that house property. It is a gross annual value. First, municipal value, fair rent, whichever is higher. That higher amount, standard rent, whichever is lower, it will be recorded as expected rent. That expected rent, actual rent, whichever is higher, will be treated as final value of that house. So, in other words, it is called gross annual value. Out of that, we have to deduct the municipal tax actually paid, not due. We have to see the municipal tax actually paid. We have to deduct to arrive at net annual value of that house property. Okay. Next, we will see for the deemed let out house property. Municipal value will be there and fair rent will be there, whichever is higher. Higher amount should be compared with standard rent, whichever is lower should be treated as expected rent. That should be compared with actual rent, but it is a deemed let out house property. It is in other words, it is a self-occupied house property, but the SSC is having more than 2 self-occupied property, then remaining will be treated as discussed earlier as a deemed let out house property, and as there will not be any rent received, so that expected rent will be treated as gross annual value, and municipal tax paid, actual paid, will be deducted to arrive at net annual value. Okay, super. Next, there is some deductions that we have discussed in the salary chapter, deduction under section 16. Entertainment allowances, standard deduction, and the professional tax deduction, etc. The same thing, the same concept will be applicable here also, but deductions under section 24, standard deduction at the rate of 30% of NAV. That NAV is just computed, right? For self-occupied property, this is nil, because for self-occupied house property, NAV is absolutely nil, right? For lettered house property, the value will be arrived as a net annual value. For that, we have to count to 30%. That means, in other words, 70% will be taxable. Okay. Then deemed lettered house property also, no actual rent, only expected rent, of which the 30% we have to deduct to arrive the final taxable income. Minus interest on housing loan will be taken. For self-occupied house property, there will be interest. For lettered house property, there will be interest. Or deemed lettered house property, there will be interest. Then we have to deduct. For self-occupied, it is always negative or nil. Nil, where in which case, because in the case where SSC has not borrowed any loan for the self-occupied property, in that case, the value of that income of that self-occupied house property is treated as nil, because there is no income, no expense at all. If he has borrowed some of the amount, then that interest portion will be treated as deduction. The net to final value will be negative figure. For lettered house property, we have to deduct the interest on loan. For deemed lettered house property also, we have to deduct the interest loan. Okay. Then we will discuss it. We have to discuss the municipal value. Means it's the value of property as per municipality board, as per local authority board, as per local panchayat. There is one register in that it contains the value of that property. It is something like municipal fair market value. In other words, municipal value. It will be given in your question also. Fair rent. Fair rent means the rent of similar property. So fair rent means it's a fair market value. Okay. Municipal value, it will be given for you to in the question answer, but it is in practical life, it will be there as per the municipal records. Okay. Fair rent means the rent of similar property in the same locality. For example, I am residing in Bengaluru main area, for example, Malleshwaram, and the same property, same size ka property in the same location, that is Malleshwaram. How much rent that owner is charging? Usually, it is a fair rent. It's a fair market value, something. Also known as reasonable rent or reasonable letting value. The standard rent. Standard rent means is the rent as per Rent Control Act. There is one act called Rent Control Act. A maximum rent that can be legally recovered by the owner of the house property from the tenant. Okay, there is a maximum cap that the owner can be charge. Owner can charge the rent as a rent from the tenant. Okay. Then actual rent. Actual rent means actual rent received plus actual rent receivable which is not been received. That means it is a rent due, in other words, minus unrealized rent. Okay, what do you mean unrealized rent? We will see in the next point. Okay, it is a formula: rent received plus rent receivable minus rent realized rent. Municipal tax. Municipal tax means it is a tax which is recovered by the municipality or local authority or gram panchayat. It's called a house tax, property tax, etc. It's also called okay. But remember that point is it is allowed only on payment or cash basis. For example, in 23-24, that owner has not paid the municipal taxes, then he cannot claim that deduction from the gross annual value, even though it is on due basis, because we have to see whether it is paid in actually in cash or some other electronic mode. Okay. Cash means not in only through cash, it can be done in electronic, but however that should be paid, that's it, by the owner. The allowed is only if it is paid by the owner of the company, owner of the house property. Suppose if it is paid by the tenant, then it cannot be deducted from the gross annual value. If it is paid by only by owner of that house property, then it can be deducted, okay, from the gross annual value. Then if in question, if a municipal taxes is given on percentage basis, then it should be computed on municipal value. Let's say municipal value is 10 lakh or for 5 lakh, then that is when question there is a percentage is 5%, then we have to take 5% on 5 lakh or whatever may be the municipal value given in the question. Okay, simple. Next, interest on loan. This is very interesting concept. It's allowed as a deduction if loan is borrowed only for the purpose of house property. The loan should be only borrowed for the house property only. For example, construction, for the repairs purpose or renovation purpose, that loan should be borrowed. It can be borrowed from banks, financial institution, and trust and friends and family also it can be borrowed. There is no restriction that you have to borrow only from banks or financial institution. It can also be borrowed from family or friends also. But interest is allowed on due basis. Even though it is not been paid, it can be claimed as a deduction by the owner of that house property. Okay, simple. Unlike that municipal taxes, where it says that it should be it can be taken as a deduction only if it is actually paid. Here, it is allowed only even though if it is not been paid at all. Then interest on loan, interest on interest, that is in simple terms it is called penal interest, cannot be taken as a deduction. Only interest charged can be taken as a deduction. Interest on interest, if interest is not at all paid or something, there will be in statement that is called penal interest. That penal interest you cannot claim, okay, as a deduction. Then there is a limit of deduction of interest on loan. For first we will say that for lettered house property or deemed lettered house property, the entire interest that you have paid, that is been accrued, can be taken as a deduction under section 24 against the gross net annual value. Okay, to arrive at the final taxable house property income. If it is taken for self-occupied house property, that is up to for 2 houses, there is 2 division. If it is borrowed, special class we will discuss. If it is borrowed, the loan is borrowed on or after 1st 4 1999, plus for the purpose of purchase or construction of house property. If the loan is borrowed for the construction, then the construction should be completed within 5 years from the end of the year in which loan was borrowed. Okay, I will once again repeat. The loan should be taken on or after 1st 4 1999 for the purpose of purchase or construction. If the loan is borrowed for construction, that construction of the house property should be completed within 5 years from the end of the year in which a loan was borrowed. For example, I have taken the loan on 1st April 2017. Okay, the house property should be completed within. Actually, we have to see from the end of the period in which the loan was being taken. The end of that loan was borrowed in 1718. From the end of the means 31st March 2018. We have to see 5 years from that 31st March 2018. Next 5 years, that is up to 31st March 2023. You have to construct your house. Understood? If it is not being constructed, the loan, the maximum loan of deduction of 2 lakh will not be given. Okay, I will discuss in the next slide. If it is all the 3 conditions are satisfied, then the maximum loan that you can claim as a deduction for self-occupied house property for 2 houses is 2 lakh. If it is loan taken before 1st April 1999, or if the loan is not taken for any other purpose, for example repair purpose, then or the construction is not completed within 4 years that we have discussed in the example, then the maximum cap will be 30,000. You can only deduct 30,000 as a deduction from the net annual value. Understanding, right? First, I am talking about self-occupied house property. Now we are talking of we have already discussed self-lettered house property. Entire interest paid. There is no restriction that they should be completed. There is no restriction. There is no limit. You can take unlimited amount of interest that is being specified by the house loan statement. Okay. But there is one note. If you are opting for 115 BAC, then there is no deductions can be allowed if you are for the self-occupied house property as a deduction in respect of interest on housing loan. We have discussed just now that maximum 2 lakh or 30,000 can be claimed as deduction on satisfaction of some of the conditions in respect of self-occupied house property. But remember, if you are opting for 115 BAC, that limit is not being, because there is no amount that you can claim as a deductions. The interest on loan deduction is nil at all if you are opting for 115 BAC only for self-occupied house property. If you are opting for 115 BAC for lettered house property, then that entire interest can be given, allowed. Okay, simple. If a fresh loan is borrowed for repayment of earlier loan, and remember that earlier loan is taken for construction or purchase of house property, or repairs of house property, then interest on fresh loan shall also be allowed as a deduction. Super, na? If a fresh loan is borrowed only with the purpose of repayment of that earlier loan, remember that earlier loan should be provided, that earlier loan should be taken only for the purpose of house property, then fresh loan ka interest can also be taken as a deduction. Super. Then interest is paid outside India. Loan is borrowed somewhere outside India. Interest is also paying outside India. Shall not be allowed as a deduction if TDS is not deducted on such interest. There is some provision called we have to deduct the TDS under something called 194A, which we'll discuss in the TCS concept. Okay, chapter. If interest is paid outside India, if TDS is not deducted under some of the provision, then that interest portion will not be taken as a deduction. If TDS is deducted, then you can take. Okay. Then there is one concept called pre-construction interest. It means interest paid before the year in which construction was completed. It is allowed in 5 equal installments from the year in which the construction was completed. There may be situation that you have borrowed income before the construction also, but that before the construction interest will be called as pre-construction interest. We'll see one example to get thorough with that. For example, loan is borrowed on 10 lakh loan is borrowed on 1st December 2020. The rate of interest is 11%. Construction is being completed this year 15th January 2024. Okay, it says that it is allowed in 5 equal installments from the year in which construction was completed. Super. The construction is completed in 23-24. Till 23-24, at the beginning of 23-24, whatever may be, whatever was the interest that can be taken as pre-construction interest. For 2021, the interest is because it is borrowed in December 2020. 2020 interest 10 lakh into 11% into 4 months, because December, January, February, March. 4 months divided by 12 months, 36,667. For 21-22, 10 lakh into 11%, that is 1,10,000. For 22-23, 10 lakh into 11%, that is 1,10,000. All three comes around 2,56,667. That is the accumulated pre-construction interest. The 23-24 interest up to the period of that construction up to 15th January 2024, that can also be taken as a pre-construction, correct? But law says that up to the completion, up to the end, up to the beginning of the year in which that house property is constructed. So in this example, that house property is constructed in 23-24, up to the beginning of 23-24, whatever may be the interest can be taken as pre-construction interest. So that 2,56,667 that accumulated pre-construction interest can be divided, can be apportioned equally, that is 51,333 can also be taken as a deduction in excess of that per year in upcoming 5 years from 23-24 to next 28-20 up to till 28-29 if I am not wrong. Then again 23-24 का interest होता है ना, that 10 lakh into 11%, that is 1,10,000, that also can be taken as of that interest. So for 23-24, the total interest available is 1,10,000 this year ka interest plus 51,333 the apportioned interest, pre-construction interest ka benefit will be taken, that is 1,61,333. But remember that one point, remember, if it is taken for self-occupied house property, that limit should be taken for this also. It should be maximum limit restricted to 2 lakh only. If it is pre-construction interest plus this year ka interest is more than 2 lakh for self-occupied property, then it should be restricted to 2 lakh. If it is for lettered house property, then entire interest can be taken. Okay, super. If it is all self-occupied, it should be restricted. The extra portion is lapsed. That's it. So unrealized rent, that we have discussed earlier, that we will discuss in the next point. Unrealized rent and recovery of unrealized rent. What if we have discussed? The actual rent means a rent received plus receivable rent minus unrealized rent. Unrealized rent means a rent which is not recovered by the owner from the tenant. It is like a bad debt of the rent, but it is in simple words, it is also a receivable rent, right? Then why should be deducted? There is one rule specified therein. it can only be deducted from that formula if the following four conditions are satisfied, which is being specified under Rule 4 of Income Tax Rules 1962. Okay, the tenancy should be bona fide. The tenancy agreement should be good. That should be clear cut. There should not be any misguide in that. There should not be any miscommunication in that. There should be bona fide. Okay, the tenant should have been vacated as a house property. He should actually vacated that house property. There is a proof. There should be a proof. Then such a tenant should not occupy any other house property of the same SSE. Okay, understanding, right? That tenant should not occupy any other house property of the same or legal owner of that house, any other house property. Okay, then reasonable steps should have been taken into consideration by the owner of that house property. That SSE, that owner or SSE should carry out some of the procedures to find out that tenant wherever is there. He should carry out by phoning him, by contacting his relative to collect the rent. That reasonable steps should have been taken. Okay. Then there is one point. Unrealized rent can also be reduced from gross annual value. There is one second step that we have reduced that unrealized rent from the actual rent, right? Rent received plus receivable minus unrealized rent. There is another step is there, another method is there. It can also be deducted directly from the gross annual value. Gross annual means expected rent or actual rent, whichever is higher, that one amount will be there. From that you can deduct that unrealized rent. Okay, but we used to follow the first method. Okay, if you follow the second method, it is also fine, but you have to mention in the note that we have deducted the unrealized rent from the gross annual value, so that examiner, so that evaluator will be known that what you have followed. Okay, super. Arrears of rent, it means it is a rent under dispute. That rent is under the court stage, or it is under rent dispute. It is not being collected due to that it is under stay. Okay, section 25A says that recovery of unrealized rent and arrears of rent. It is one, remember, is recovery is taxable in the year in which it is actually received, actually recovered under the head IFOA, income from house property, whether the SSE is the owner of that house property or not in that financial year. Suppose 2021 ka rent we have not realized. We have claimed a deduction under as per actual rent formula. In 23-24, I am not the owner of that house property. I have sold that house property to any other person. But that in that financial year 23-24, I have recovered that unrealized rent from the tenant in this financial year. You cannot say that I am not the owner of that house property. I am not responsible for rent that actually no, because I am not the legal owner of that house property. You should be taxed for that those persons who has been transferred that house property by me. You cannot tell like that. You have to be responsible for that rent. You have to take that rent for your computation of income, okay, as a taxable income. Any expenses incurred for such recovery, for example, court fees or legal professional fees for the lawyers, should be ignored, because the taxable amount is the recovered amount into 70%. That's it, because the 30% standard deduction will be given to you. Okay, and hence we are ignoring that other expenses like lawyer fees or any other legal fees or court fees, etc. Because 30% standard deduction will be given for this also. Okay, the taxable amount is recovered amount into 70%, or 30 minus you can deduct from the recovered amount. That's it. Any other property expenses, till now we have discussed recovery of amount. Thus we will discuss some other point with regard to this rental house property income. Other property expenses will be there. No, for example, repairs expenses, insurance charges for your house property, then social society charges, parking charges, lift charges, or any other electricity, water charges, etc., etc., etc. That you cannot claim, because standard deduction of 30% is being allowed for you, right? So income tax believes that the 30% forms these expenses. That's it. Okay. Then there is one concept of vacancy. Vacancy means that we have just discussed that the tenant has vacated the house property. In that case, how we have to compute the actual gross annual value? There is some basic concept. What basic concept says? Expected rent or actual rent, whichever is higher, will be treated as gross annual value, right? In as per our statement of income from house property. However, if actually there is two cases we will see. If the expected rent is less than or equal to actual rent plus vacancy rent. Vacancy rent means rent would have been received if the tenant is not vacated that house property. That is called vacancy rent. Understand, right? The rent would have been received if the tenant is not vacated his house property. That is called vacancy rent. Then actual rent. If it is less, if it is more than that expected rent, then a gross annual value shall be actual rent only. Because if there would not be that vacancy period, vacancy concept, then the actual rent would be the gross annual value, right? As per this formula, whichever is higher concept. You can see the formula is expected rent or actual rent, whichever is higher. If the actual rent plus vacancy rent is more than the gross and more than expected rent, then actual rent will be taken as the gross annual value. Second case, if the expected rent is more than both these two, that's actual rent plus vacancy rent, then usually the expected rent will be treated as gross annual value as per the formula, right? We'll see one example. Monthly rent is 15,000 per month. Expected rent is given in the question as 1,50,000. Vacancy is for 3 months. That means the vacant period, that tenant has vacated his property for 3 months. That means that owner has collected rent only for 9 months, right? Then we'll see that we'll apply that formula. Expected rent is 1,50,000. Actual rent is 1,35,000. Means 15,000 into 9. 15 nines are 135. 1,35,000. Plus vacancy rent means the rent would have been received if tenant is not vacated his house property. Then that is for 3 months. 15 into 3 is 45,000. If you add these two, 1,35,000 plus 45,000 will come around 1,70,000, which is more than expected rent, and hence we will take the gross annual value as 1,35,000. Okay, understand? Because why we are not taking that 45,000? Because it is unrealized rent. We will deduct that. But remember that the deduction will be only possible that the rule 4 condition should be satisfied. Okay, and hence we are taking 1,35,000 as a gross annual value. What is the reverse case? Reverse case is expected rent is, let's assume, 2 lakh. Then actual rent plus vacancy rent will come around 1,70,000. Expected rent is obviously more than this actual rent, right? If the vacancy is not there, then actual rent would be 1,70,000, right? 1,80,000, right? Because 1,35,000 plus 45 will come around 1,80,000. If the vacancy is not there, then the actual rent would have been 1,80,000, right? 15,000 into 12. Obviously, that expected rent is more than that actual rent. Then we'll automatically take that expected rent as per the formula, right? And hence, in this case also, expected rent will be treated as gross annual value. I hope you have understood this concept. Little bit complex, but I hope I have made this as simple as possible. Okay. Next, some of the minor concepts. That was not important concept, but this is very important. Partly lettered house property, area wise. What do you mean that? If some of the area of the house property is let out and the remaining part of the area is used for self-occupied, then let out proportion is treated as let out house property, then self-occupied portion is treated as self-occupied house property. Simple. Hence, the municipal value, standard rent and fair rent, municipal tax and interest loan also should be equally divided based on the area wise. How much portion is for let out house property? How much we have to apportion it? In your question, there will be given 1/3 of house property will be treated as let out house property, and then remaining 2/3 will be treated as self-occupied house property. Then you have to divide all these, the municipal value, standard rent, fair rent, municipal tax, interest in that proportion only. 1/3 let out house property, 2/3 for self-occupied house property. Understanding, right? But remember, there is one concept, there is one silly concept, there is one joke concept. Actual rent cannot be divided because it is an actual rent. You cannot apportion it among self-occupied house property, right? It's illogical. It can be only taken for let out house property. That's it. Okay, it is not to be divided again. Okay, Next, a concept of partly lettered house property, the time wise. If the property is lettered for some period of time as a let out and self-occupied for remaining part of time of the whole year, then such property is always to be treated as lettered house property. Remember, the property is let out only for one day also. Remember, only one day also in the whole financial year in the 23-24. Then that house property should always be treated as lettered house property, even though for the remaining 365 remaining days it is being self-occupied house property. In the 23-24 there are 366 days, right? For 1 day you have utilized it for lettered house property. Then for remaining 365 days you cannot treat it as self-occupied house, but it is deemed as it is entirely used for lettered house property, and apply the above procedure. That's it. Remember, SSE has, if the SSE is more than two self-occupied house property, then you have already discussed up to two house property can be treated as self-occupied, remaining can be treated as limited lettered house property. But it is left to the option of the SSE. Why is it that you have that SSE have to apply the concept? In which case I will be charged less income tax. I will be charged as a less income. Suppose three house property, self-occupied house property is there. He has to utilize his mind. You can take the help of some of the professionals, that which property can be taken as self-occupied property and which is treated as lettered house property. It is depending upon his actual option, depending upon the least income chargeable under the whole income from house property. Okay, it can be easily understood with the examples that has been given in the questions. Then there is a concept of joint ownership. It's also called co-ownership. Means the property is owned by more than one owner. In this case, the income of those property is calculated normally, then apportioned between the co-owners in their co-ownership ratio. Okay. But the division of interest on a loan in case of co-ownership, the interest on loan can be divided in this proportion. If it is that lettered house property or deemed lettered house property, if the property is co-owned, then full interest is allowed. Okay. Then for it is for self-occupied house property, then that self-occupied house property is being co-owned, then 30,000 or 2 lakh as the case may be. As the case may be means there is three conditions, right? Up to after 1/4/1999 for the purpose of purchase or construction. That construction should be completed within 2 years, within 5 years. Then the limit is 2 lakh. In other cases 30,000 as the case may be. Into number of co-owners will be given. For example, 2 as the case may be, as the case we will arrive at the maximum limit of 2 lakh. Okay, after the satisfying all the condition. If the property co-owners is 2, then for each that limit will be given. For 2 lakh, 2 lakh. 4 lakh is the ultimate loan amount or actual rent, which actual interest, whichever is lower. Okay, this is one new concept. Then we will see the concept of composite rent. Composite rent means there is a rent of house property as well as the rent of from the other asset also. Then we have to see if the rent agreement is separable. There is a clause that this is a portion and there is actually a portion. Then if the agreement is separable, agreement means there is a concept of this apportionment. Then that rent of house property will be chargeable under income from house property. Rent from other asset is treated as PGB, that is business income or income from other sources. If agreement is not separable, there is no mention of separability, then total rent is treated as income from house property, income from other sources or business income as the case may be. Okay, there is one note. If lettered house property is not feasible without the other asset, then total rent is taxable under the head PGBP or income from house property, whether such a rent is the agreement is separable or not. In case of hotel, you can see there might be a situation called the machinery has been hired. Machinery has been hired for machinery purchased on higher basis. You will be paying that rent for that machinery, and also there is a house property. There is a room facilities also. For that you will be rent facility. Because it is not at all possible for that owner to classify, so this is not feasible and hence it is always treated as business income or income from house property, income from other sources as the case may be, not under income from house property. Okay, Then the last concept of this chapter is section 27. It is called deemed ownership. Deemed owner. There are four criteria, four conditions. Not condition, there is one cases. If any individual transfers any of the house property to his spouse, his or her spouse, for without consideration, for free, in other words, or inadequate condition, they actually not in full consideration, then such individual, that is transferor, who has transferred that house property, will be treated as deemed owner of that house property. The entire income will be charged for that transferor only, not under the head transferee. Understanding, right? Actually, it's called application of this, called diversion of income. That's it. So, in order to catch that, in order to actually avoid that concept, that income tax authority has brought into this concept, that individual, the transferor, will be held responsible for that income, whatever may be the income. But there is one exception. If the transfer is necessary in connection with live apart, there is a mutual understanding is there that we actually will live apart, then if any transfer is being carried out in between these couples, then there is that house property income will not be charged under the head transferor. It will be charged in the hands of transferee. Okay. Then if any individual transfers his house property to minor child, there is a concept on minor child, very important, for without consideration or inadequate consideration, then he would be treated as deemed owner. P means the transferor will be treated as deemed owner. There is one exception: minor married daughter, balya vivaha. Okay, if the house property is transferred to minor married daughter, then this concept will not be applicable, because she would be responsible for that, not the transferor. Okay. Then in case of a cooperative society, shareholder is treated as deemed owner of such a house property. In case of, we'll take an example of Gokultam society, Tarak Mehta ka Ulta Chashma, that respective shareholder, that is Jethalal or Mehta or Bide, will be treated as deemed owner of that house property. Then holder of impartible estate is not so important, not required any much of the definition also. There is not been definition at all. Please remember that impartible estate also, in case of impartible estate also, that holder of that impartible estate will be treated as deemed owner. Okay. Now we have successfully discussed that this chapter, that is income from house property. If you have any doubts in this chapter, you can simply mention your doubt in the comment section, or you can reach out to me in the LinkedIn, through Instagram, or you can also mail me with your doubts. I will be very happy to answer your queries. I hope you have revised the this concept, and we'll see in the next chapter, that is PGPP. Very vast, very important chapter, one of the important chapter for your examination. Till then, please revise this concept again and again. Till then, see you soon. Just welcome. This is Abhijith Acharya signing off. Abhi CA Classes. Have a good day. Bye bye.